So you want to own an EV charging station. Picture the scene. A sedan rolls in under a steel canopy, backs toward a squat gray cabinet, and a cable thick as a garden hose clicks into the charging port. A screen lights up. A number starts climbing on the dashboard, 15 kilowatt hours, 16, 17, while the driver leans against the door and scrolls a phone. You watch that number climb and do the math in your head. Electricity is cheap. You are selling it at a markup. 10 more stalls like this one, running all day, and this looks like a slot machine that never has to pay out. You think, this is basically a vending machine for a commodity everyone already needs. How hard can that be? Here is where most people stop thinking, and here is exactly where it gets complicated. The charger you are picturing, humming quietly and printing money 1 kilowatt hour at a time, is not the business that actually exists on the ground. According to EVgo's own reported first quarter 2026 results, one of the largest fast charging networks in the country, average utilization across its national footprint of more than 5,000 stalls sat at 21%, and had actually fallen from the prior quarter even as the network kept growing. That is the central number to hold on to here. 21%. A charger that sits idle roughly 4 out of every 5 hours it exists is not a vending machine. It is a piece of expensive, specialized real estate waiting for someone to show up. Compare that to the fantasy you started with. 10 pumps at a gas station, each one turning over a car every 4 minutes for most of the day, generate a predictable, almost mechanical stream of small transactions. A row of charging stalls, each one occupied by a single car for 20 to 40 minutes at a time, cannot physically turn over customers at anywhere near that rate, even at full capacity. The ceiling on how much revenue a single stall can generate in a day is structurally lower than a fuel pump's, no matter how you price the electricity. And the biggest twist in this business is not about electricity prices at all. It is that the single utility bill you never think about, the one for how much power you might draw in your worst 15 minutes of any given month, can determine whether the whole site survives, regardless of how many cars you actually charge. Before you spend $1, understand that not all charging stations are the same asset. Walk up to what looks like one uniform category of business and you are actually looking at several different products wearing the same canopy. A level 2 charger, the kind bolted to a wall at an apartment complex or a grocery store parking lot, delivers 7 to 19 kilowatts and is built for a car that is going to sit for hours anyway. A DC fast charger, the kind installed along a highway corridor, delivers anywhere from 50 to 350 kilowatts and exists to get a driver back on the road in 20 to 40 minutes. These are not the same business at different price points. They are different businesses with different customers, different cost structures, and different reasons to exist. A workplace adding 4 level 2 ports to an existing lot is underwriting a benefit for employees who are parked there anyway. A travel corridor operator building a 4-port fast charging plaza is underwriting a piece of critical infrastructure that a stranger will use once and never see again. Confusing the two is the first mistake almost every new entrant makes. There is also a second axis of variation that has nothing to do with charger speed, who actually owns the equipment and who keeps the money. Under the owner-operator model, a single party buys the hardware, pays for the installation, and keeps every dollar of session revenue after expenses, taking on the full risk of a slow utilization site in exchange for keeping the full upside if the location takes off. Under the site host model, a property owner, a grocery chain, a mall, a hotel, hosts a network operator's equipment on their land in exchange for a lease payment or a small cut of revenue, taking on almost none of the equipment risk but also almost none of the upside. And under the revenue share model, increasingly the most common structure for mid-size commercial sites, the network operator installs and maintains the hardware while the property owner takes a percentage of charging revenue, splitting both the risk and the reward. Which structure makes sense depends on whether the property owner sees charging as a profit center in its own right or as a foot traffic amenity that happens to generate a little extra income on the side. Building a site as if it were the former when the underlying economics only support the latter is the second mistake almost every new entrant makes. What it actually costs to get into this business spans an enormous range, and the reasons for that range matter more than the numbers themselves. At the minimum viable tier, you are adding charging to a site you already control, a retail lot, an apartment complex, a small commercial parking area. A commercial level 2-port, hardware and installation combined, runs $4,500 to $12,000, according to 2026 commercial installation guides drawing on Department of Energy pricing data. Add a second port on the same pedestal, some conduit, a permit, and basic signage, and a 2-port workplace installation lands somewhere between $15,000 and $30,000 all in. This is the tier most small businesses can actually afford, and it is also the tier with the thinnest, slowest accumulating revenue, because level 2 sessions run for hours and generate modest fees per visit. At the realistic mid-tier, you are installing a single DC fast charger, the kind a driver actually plans a trip around. Hardware for a 150 kilowatt unit runs $38,000 to $90,000. Installation, including trenching, conduit, and electrical work, adds another $20,000 to $60,000. Once you include the utility side work, a new transformer, a service upgrade, switchgear if the site's existing electrical capacity cannot support the load, a single fully installed 150 kilowatt port lands between $90,000 and $150,000. Push to a 350 kilowatt unit, the kind capable of charging a modern battery to 80% in well under 20 minutes, and hardware alone can run $90,000 to $200,000 before a single foot of trenching. Layer on a canopy to protect the cabinet and the driver from weather, another $20,000 to $60,000 depending on the number of bays it covers, plus concrete pad work, bollards to protect the equipment from a driver who misjudges the pull-in, and a payment terminal certified for outdoor, unattended use. And the mid-tier build easily absorbs another $15,000 to $30,000 beyond the headline charger price. At full scale, you are building what the federal government's own funding program considers a legitimate site, a minimum of 4 150 kilowatt fast chargers running simultaneously, 600 kilowatts of combined capacity, spaced no more than 50 miles apart along a designated highway corridor. That is the National Electric Vehicle Infrastructure Standard, and it exists because a single, isolated fast charger does nothing for a driver who needs a backup if it's broken or occupied. A 4-port compliant plaza, once you include land or ground lease, canopy structure, all 4 dispensers, the utility service upgrade, a retail kiosk or convenience structure, and network management software licensing, runs from roughly $750,000 at the low end to well over $2.5 million at sites that require a dedicated substation. Here's the detail almost every first-time developer underestimates. Hardware is typically only 20 to 35% of that total. Electrical make-ready work, the panel upgrades, the trenching, the utility coordination, the transformer, routinely consumes 50 to 70% of the entire project budget. You are not really buying chargers. You are buying a small, permitted power plant that happens to have a credit card reader bolted to the front of it. Stack the real numbers side by side and the gap between tiers stops looking incremental and starts looking like 3 different industries wearing the same signage. A level 2 port installed runs $4,500 to $12,000. A single 150 kilowatt fast charger installed runs $90,000 to $150,000. A 350 kilowatt unit can clear $200,000 before the canopy goes up. A 4-port compliant highway plaza clears 7 figures before the first car ever charges. Each step up that ladder is not a bigger version of the same purchase. It is a fundamentally different balance sheet, a different customer, and a different tolerance for how long the asset can sit half-used before the debt service becomes a problem. Now follow the money after the site is built, because this is where the fantasy and the reality split apart. You'd assume a fast charger earns money every hour it's plugged in and switched on. It doesn't. It earns money only during the minutes a car is actually drawing current, and even then, the amount it earns depends on a mechanism almost nobody outside the industry has ever heard of, the demand charge. Here is exactly how it works. A commercial utility customer isn't billed only for total energy consumed in a month, measured in kilowatt hours. Most commercial and industrial utility rate structures also bill for the single highest 15-minute average of power draw recorded anywhere in that entire billing cycle, measured in kilowatts, and that peak sets a fixed charge for the whole month regardless of how many times it happened or how many cars were actually charged. A 350 kilowatt fast charger that runs at full output for even 1/4 hour, whether that was one car on a busy Saturday or an idle test during a slow Tuesday morning, can set a demand charge that then gets billed every month until a new, lower peak displaces it. According to energy management research from Drivs, a charging network software provider, grid costs including demand charges can account for 40 to 60% of a charge point operator's total operating expenses, and effective demand management strategies can cut that total energy cost by 20 to 40%. That is not a rounding error. That is the difference between a site that's profitable and one that quietly bleeds money every month while looking, on paper, like a busy and successful location. That demand charge is also the clearest example of an invisible cost in this business, the one that never shows up in a first-pass income projection. A spreadsheet built from a charger's rated output and an assumed number of daily sessions will produce a clean, optimistic revenue line. It will not, on its own, produce a line for the single 15-minute spike that occurred at 2 in the afternoon on a Saturday 6 weeks after the site opened, the one that reset the baseline utility bill for the following 12 months without anyone noticing until the statement arrived. That cost does not announce itself. It shows up on a bill, months after commissioning, as a number the operator did not budget for and cannot easily undo once the rate tier has been triggered. The second mechanism is the one that separates this business most sharply from the gas station it superficially resembles: dwell time interacting with a declining charging curve. The assumption that a charger earns at its rated speed for the entire time a car is plugged in turns out to be wrong too. A lithium-ion battery accepts power fastest when it is nearly empty and slows dramatically as it approaches full, tapering hard past roughly 80% state of charge to protect the battery's chemistry. That means the advertised maximum output of a charger, the number on the sign, is only ever hit for a portion of any given session, and a driver who stays plugged in past that 80% mark is occupying a valuable stall while drawing a fraction of its rated power, often at a rate closer to a fifth or a tenth of what the sign promises. A gas pump fills a tank in 4 minutes at a nearly constant rate. A DC fast charger needs 20 to 40 minutes, and the last 10 of those minutes are the least profitable ones in the session, the ones where the stall is occupied but barely earning anything at all. Every operator managing a real site has to decide structurally whether to price idle time after charging completes to discourage overstay, whether to cap sessions at 80% and post that limit on the screen, and whether to size the site for peak hour queuing or simply accept that some fraction of drivers, seeing a queue, will turn around and leave for a competing network down the corridor. The third mechanism is subsidy stacking, and it is the one that currently determines whether a full-scale build even pencils out at all. The federal Section 30C tax credit returns 30% of qualified equipment and installation costs. State and utility make-ready programs, where utilities cover part of the electrical infrastructure cost in exchange for guaranteed future load, can cover a meaningful share of the remaining electrical build-out. NEVI funding, $5 billion apportioned across fiscal years 2022 through 2026, was designed to cost-share the most expensive, least revenue-certain tier of this business, rural and low-traffic highway corridors that would never otherwise attract private capital. According to 2026 industry cost guides, these sources combined can offset 30 to 90% of a site's installed cost, depending on location and how carefully the application sequencing is handled. But that funding has not been stable. A federal budget resolution signed into law in early February 2026 cut roughly $500 million from NEVI, even as $9 billion in prior obligations sat only partially disbursed, and a 2025 funding freeze, later overturned by a federal court order, had already delayed disbursement to states for the better part of a year. An operator who built a financial model assuming subsidy dollars on a fixed timeline learned, the hard way, that government cost share is a real and material input to this business, not a rounding error at the bottom of the pro forma. These three mechanisms reinforce each other in a specific, unforgiving way. A site with low utilization can't spread its demand charge across enough sessions to make each one profitable. A site with thin per-session margin because of demand charges depends even more heavily on subsidy dollars to make the original capital outlay worthwhile. And a site that can't count on subsidy timing has no choice but to lean on the one lever fully within an operator's control: what happens inside the building next to the chargers, during the 20 to 40 minutes a driver is standing around with nowhere else to be. That dwell time, oddly enough, is this business's one genuine structural advantage over the gasoline station it is often compared to. A fuel customer is in and out in 4 minutes. An EV customer is captive for the length of an entire meal. The clearest real-world illustration of how these mechanisms actually play out sits inside EVgo's own quarterly disclosures. In its fourth quarter 2025 earnings report, the company announced its first quarter of positive adjusted EBITDA, $24 million, up sharply from an $8 million loss the year before, driven by 37% growth in charging revenue and a network utilization rate that had climbed to 24%. Investors and analysts treated it as a turning point for the entire public charging category, evidence that the build first, monetize later model could eventually work. Then, in the very next quarter, first quarter 2026, the same company reported record revenue of roughly $110 million, up 45% year over year, and in the same release disclosed that network utilization had fallen back to 21% and throughput per stall per day had declined as well, because new stalls were coming online faster than driver demand was catching up to them. Adjusted EBITDA swung back to a $7.5 million loss. 2 consecutive quarters, same company, same underlying network, and the story flipped from turning point to caution sign purely on the back of a utilization swing of a few percentage points. That volatility is not a management failure. It is the mechanism itself, made visible in a public company's financial statements. The pattern is not unique to one operator. ChargePoint has reported that charging demand across its network has been outpacing the growth of new charging ports, meaning existing stalls are working harder even as the company adds more of them, a dynamic that cuts the opposite direction from EVgo's utilization dip but underscores the same underlying point. In this business, utilization is the number that decides everything else, and it moves independently of how much capital has been deployed. Meanwhile, Tesla's supercharger network, built years earlier and now open to other manufacturers' vehicles under the NACS connector standard, still controls roughly half of the country's fast-charging market by most industry estimates, a scale advantage built on years of higher, steadier utilization that newer entrants are still trying to replicate site by site. Separately, a National Renewable Energy Laboratory case study analysis of fast-charging business models found that under current adoption and utilization patterns, sites structured as a private operator working alongside a public cost-sharing partner were the ones most reliably protected from financial loss, and that demand charges together with the retail electricity rate an operator pays were the two factors that most affected whether a given site turned a profit at all. That is a government research lab arriving, independently, at the same two levers a network operator's own earnings calls keep returning to. So what separates the operators who make this work from the ones who don't? One bad quarter hour sets the bill for the whole month, and the operators who understand that sentence in their bones are the ones who survive their first year. The winners model the demand charge before they ever pour concrete, not after the first utility bill arrives. They know before a site opens, roughly what their worst 15-minute draw is likely to be and they design around it, sometimes installing on-site battery storage specifically to smooth out peak draws and avoid triggering the highest tier of demand pricing, even though that storage adds meaningfully to the upfront capital cost. Some negotiate directly with the utility for a time-of-use rate structure that rewards charging during off-peak hours, shifting fleet and overnight sessions away from the exact window that would otherwise set the monthly peak. The winners also treat the retail program as the actual business, not an afterthought bolted onto the chargers. A travel plaza operator who understands that a charging customer dwells for half an hour, not 5 minutes, builds a real food program, comfortable seating, and a reason to walk inside, rather than a vending machine and a restroom. It works when the demand charge is modeled before the first shovel goes into the ground, when the retail program is built around a 30-minute dwell time instead of a 5-minute one, and when the subsidy stack is sequenced and applied for months before construction starts rather than chased retroactively after the concrete has already been poured. Because a single demand charge peak decides the bill for the whole month regardless of how well the rest of the site is run, the best operators treat that number as the first design constraint, not a line item to worry about after opening day. The winners also watch utilization site by site rather than trusting a network-wide average, because a single high-traffic corridor location and a single underused suburban lot can sit inside the same portfolio and tell completely opposite financial stories, and a blended average across both can hide a location that is bleeding money every month without it ever showing up in the top-line numbers. And the winners understand something almost nobody discusses when they're pitching the idea: the network software subscription. Every dispenser on a managed network typically carries a recurring purport software and payment processing fee to the network operator, often overlooked in a first pass at the numbers because it never shows up in the capital budget, only in the monthly statement, steadily eating into margin on every single transaction for the life of the asset. Add to that the roaming fees paid when a driver charges through a third-party app rather than the site's own network, and the payment card fees on top of that, and the gap between the price posted on the screen and what the operator actually keeps narrows further still. There is one more cost line that rarely makes it into a first-year budget: uptime. A charger that is broken, whether from a failed connector, a payment terminal glitch, or a cooling system fault on a liquid-cooled high-power unit, earns nothing while it sits dark, and federal funding programs like NEVI now require a minimum 97% uptime standard as a condition of eligibility. Meeting that standard means budgeting for preventive maintenance contracts, spare parts on hand, and a technician on call, none of which shows up in the sales pitch but all of which shows up in the operating statement of every site that has been running for more than a year. 3 real scenarios show how differently this can play out, and almost all of the variance comes down to which one you land in. Scenario 1, the workplace add-on. A mid-sized office park installs 6 Level 2 ports as an employee amenity, total installed cost around $45,000 after available utility rebates. Utilization is high by Level 2 standards, cars plugged in for 6 to 8 hours during the workday, but the procession fee is modest and demand charges are minimal because Level 2 draw is small enough to stay under the threshold where most utilities even bother with demand-based billing. Annual revenue lands around $18,000. After software licensing, minor maintenance, and a share of the site's electricity cost, net income is close to break-even in year 1, turning modestly positive by year 3 as utilization matures and employees adjust their commuting habits around the new amenity. This is not a wealth-building investment. It is a tenant retention and amenity play that happens to wash its own cost over time, and the property owner who installs it for that reason, rather than expecting it to perform like a highway plaza, is the one who ends up satisfied with the outcome. Scenario 2, the realistic mid-tier operator. A single 150 kilowatt fast charger installed at an existing retail center, total cost around $120,000 after a partial utility make-ready credit. At moderate utilization, 40 to 60 sessions a week, monthly gross revenue runs $3,000 to $5,000. Demand charges consume a third to half of that before any other cost is paid, and that share climbs in the summer months when the retail center's own air conditioning load pushes the site's overall peak draw higher independent of anything the charger itself is doing. After software fees, card processing, insurance, and a share of site maintenance, net income lands somewhere between $8,000 and $20,000 a year, an acceptable but unspectacular return on a six-figure asset, one that depends entirely on whether the surrounding retail center already had walk-in traffic to begin with. Add a second port to the same pedestal in year 2, once the first has established a baseline of demand, and the marginal cost of that second port is far lower than the first, because the utility service upgrade and the trenching are already paid for. Most single-site operators only figure this out after the fact. The second port on an existing pad is a dramatically better investment than the first one ever was. Scenario 3, the full-scale highway plaza. A 4-port, NEVI-compliant fast-charging site built along a designated corridor. Total cost $2 million after stacking the federal tax credit and a state cost-share award covering roughly half of eligible expenses. In a strong year, steady highway traffic, no major grid upgrade surprises, a real food and retail program capturing the 30-minute dwell time, the site can generate $300,000 to $500,000 in combined charging and retail revenue with a net operating income in the range of $60,000 to $150,000, once debt service and the demand charge drag are accounted for. In a weak year, a nearby competing plaza opens, a subsidy payment is delayed past the fiscal year it was budgeted for, or a single new demand charge peak resets the utility bill upward for 12 consecutive months, that same site can post a loss even while charging more cars than it did the year before. The difference between the good year and the bad year has less to do with how many drivers pull in and more to do with whether the 15 minutes nobody was watching happened to fall inside that month's utility bill. That subsidy exposure in Scenario 3 is not a hypothetical. A 2025 federal freeze on NEVI disbursements, later overturned by a court order, held up state funding for the better part of a year before a subsequent ruling in early 2026 released obligated funds and let stalled state solicitation rounds resume. Weeks later, a separate federal budget resolution trimmed roughly $500 million from the same program's remaining allocation. An operator who had underwritten a site assuming a fixed federal cost share on a fixed timeline spent a year finding out that government money, however real on paper, arrives on a schedule set by politics, not by construction deadlines. The developers who fared best through that stretch were the ones who had underwritten the site to work, marginally, even if the subsidy check arrived a year late or shrank by a third. The ones who had built the subsidy into the base case as a certainty were the ones explaining a stalled project to their lenders. Picture that car again, backed under the canopy, cable clicked into place, the number on the dashboard climbing past 15 kilowatt-hours while the driver leans against the door and scrolls a phone. What you're actually watching is not a sale of electricity at a markup. It's a 30-minute lease on a piece of grid capacity, priced by a utility meter that already decided, in some invisible quarter-hour last Tuesday, exactly how expensive this particular kilowatt-hour is going to be.